back in the 70s, they had both were problematic, and so Volcker chose to kill employment to try to stabilize the dollar. And I think now, and the difference was that they had a lot of problems back then, but they had low debt to GDP, partially because they had already been inflating it away, throughout the 40s and then throughout part of the 70s. And so they had low debt to GDP, and so they could jack interest rates pretty high without causing widespread insolvency. It causes severe recession. If you look at, say, indicators of economic activity, right? So for example, if you look at purchasing managers indices, it's kind of a rate of change metric for what the economy is doing. When it's over 50, it means that basically it's expanding. When it's below 50, it's contracting, but it also gives us direction. So for example, if it goes up to 60 and then falls down to 55, it's still growing, but it's decelerating. And generally, if you look at the purchasing manager index, the PMI over the long term, it looks like a sine wave that kind of bounces around 50, generally between 60 and 40, and sometimes you get these crazy spikes or dips. And so as we enter 2022, PMIs are rolling over. And these tend to have roughly 3-year cycles. I mean, you can have a couple different PMI cycles in in something that's defined as an economic expansion, because you have these ebbs and these flows. And the problem now is that the Fed is looking to tighten into a decelerating economy by most indicators. And we had a similar effect back in late 2018. If you looked at, say, broad money supply, you had a destruction in loans, right? So you had a contraction of money supply, but then you also had stimulus. And so if you looked at broad money supply, it was roughly flat throughout that crisis. Basically, you wouldn't even know there's a crisis if you're looking at broad money supply. And so basically there wasn't like a ton more money in people's bank accounts chasing fewer goods and services. You had basically most people had less money. Many people lost their homes. They had to contract spending. There was high unemployment. In this cycle, there were a couple things that were different. One is that the fiscal stimulus was much larger and quicker right off the bat, and banks already went into this crisis well capitalized. They already had high amounts of reserves and treasuries as a percentage of their assets. And so they have other, there might be other challenges out there, but they weren't in the same situation they were in 2008. And so the goal wasn't to just recapitalize the banking system and not everyone else. It was more of that broad base, setting up like PPP loans to turn into grants, bailing out the airline industry, sending checks to people, doing childcare tax credits. Everybody, the majority of people had more money in their bank accounts. So broad money supply itself went up far more dramatically. It was the biggest spike we've seen since World War II, when you had a similar inflationary effect, by the way. And so this time it resulted in more money chasing, the same or fewer goods. Then you also add, supply chain issues, lockdowns, things like that. And another big factor that almost no economists pay attention to is the natural resource cycle. If you look at, they always focus on the demand side. They don't really focus on the supply side. And commodities go through these kind of like 15-year capex cycles roughly, where you have this period of oversupply. So you have super low commodity prices. Nobody wants to invest. And that's, they shouldn't be investing because it's just not, as you'd be destroying money. And so we had this period of oversupply, especially from the 2015 to like 2020 period. You just had oversupply of oil markets in particular. And so, but a lot of that's worked out now. The combination of investors don't want to keep lighting their money on fire, so they're basically requesting more discipline from, say, shale oil producers. In addition, you have ESG mandates, things like that. So there's not a lot of excess capital going to energy capex anymore. It's been very low, and so now we find ourselves in a much tighter natural resource market. So the combination of faster money supply growth and then all sorts of physical constraints on supply give us a much more inflationary environment, I think, in this decade compared to the prior decade. Commodity industry is a very tough business, and it's because it's one of the few industries where you can't really control the price of your own product, and because it's, you don't really have differentiation compared to competitors, and so it's somewhat inherently more subject to volatility than other industries. But then speculators do kind of amplify the tops and the bottoms of that market compared to what it otherwise would be, especially in a sound money environment. But if you look at the current environment with energy, for example, energy's got a very low stock to flow ratio. There's not many months worth of storage around, and so part of the energy shortage we've been seeing is that, for example, natural gas storage in Europe and Russia has been relatively low. We're also seeing drawdowns in oil inventories in the United States and elsewhere. And so for example, the shortages that we're seeing in the energy markets are mostly not driven by speculators. It's really about the consumption versus production. Basically, production's kind of flat compared to pre-pandemic. If in some places down. So, for example, U.S. production never got back as high, and it really shouldn't have, because some of that was, a lot of that production only came online because of those easy money policies. Basically, the combination of super low interest rates allowed and a kind of continual investment by pension funds into those things. That's where I think the manipulation was more prevalent. So that whole decade, part of, ironically, why you had disinflation was you had a lot of malinvestment kind of just going into the oil patch, basically lighting itself on fire, but providing a good amount of oil. Most of those companies were free cash flow negative throughout that whole cycle. I think there are certain markets to look at. So a lot of people say, the Fed will never let stocks crash, but there's far more sensitive things they look at more than stocks. And so, for example, during the quarter four 2018, downturn in markets, Powell had his famous Powell pivot, where they were talking about, their tightening policy was on autopilot. And then by the time you got to January 2019, he's like, just kidding, we're going to be data dependent, relax, guys, because you had everything crashing. A lot of people said, hey, look, it took a 20% downturn in the S&P 500 to make him change his tune. But the bigger thing under the surface, that was like the part of the iceberg over the surface. The iceberg under the surface was credit markets. So during that there was like a 6-week period where credit markets froze. No junk bonds were issued for like 6 weeks. And that's a much more severe problem for markets than just the S&P 500 going down 20%. And so that's the type of thing that makes them pivot. And so, just stocks going down 10, 20, 30%, Bitcoin going down, altcoins getting killed, these things are not going to make the Fed pivot on a dime. It's watching credit markets, and then it's also watching if the treasury market becomes illiquid like it did in March 2020. So those are the kind of the bigger pieces of the iceberg that would kind of force them to shift. Back in the 70s, they had both were problematic, and so Volcker chose to kill employment to try to stabilize the dollar. And I think now, and the difference was that they had a lot of problems back then, but they had low debt to GDP, partially because they had already been inflating it away, throughout the 40s and then throughout part of the 70s. And so they had low debt to GDP, and so they could jack interest rates pretty high without causing widespread insolvency. It caused a severe recession. It didn't cause like a depression. Whereas here, because you have so much debt in the system, I think they're going to err on the side of letting inflation run over their 2% target, and trying to jawbone it back down, trying to manage it around the margins, but still letting it run hot. And that's essentially what they did back in the 40s, which is the only other time federal debt to GDP was as high as it was now. I mean, we had these big inflationary spikes. You had price and wage controls, and they just held rates at zero for that entire decade, because they basically recognized insolvency. And so I think that's the framework going forward, but it's not necessarily a straight line. And so I think they're going to try to slowly tighten here, until they get some of these signals that say you're stuck, basically, because kind of their third mandate is financial stability. So if the repo market breaks, if the treasury market breaks, if credit markets break, they're kind of forced back in to reliquify whatever market that was. And so that's kind of how I'm monitoring it.